Tuesday, October 9th, 2018, Monaco 64, home of alternative economics and contrarian views. This morning, I want to look closely at the bond market and how important it is. We always hear most of the time about the stock market, what the Dow has done, what the S&P has done, but the regular investor or the man on the street, the woman on the street, the big focus is the stock market, but the bond market is the biggest capital market in the world and in the United States. And I want to talk about how it could be very significant for the health of the financial system. And I'll look how it's kind of evolved since the '08 crisis. And I started out basically working in the bond market. The firm I worked for in Switzerland, they did a lot of bonds. They had participation in a bond dealer firm in London. And then when I came to London as well, I worked in the futures and options market, which is a derivative of the regular market. And for over 20 years, I focused on government bonds. So I've dealt in corporate bonds, government bonds, futures, options, the derivatives. And I want to talk about why it's so important and how it could be very dangerous to the health of the financial markets. Before that, of course, see where the markets are as usual. It's just before 8:30 a.m. London. So where are we this morning? Well, spot gold, after I did my video yesterday, dropped down even further towards around 1183, I think was the low yesterday. Right now it's at 1188.70, so it's up about $1. It has been as high as 1192. So that's where gold is, virtually unchanged right now. Silver, it's at, I think we got down to 1425, maybe a little lower. This morning we are at 1440, up about 4 cents or 1/4%. The stock market yesterday, I noticed the Dow managed to finish slightly higher, even though it was down, I think, around 200 points intraday. I'm not sure exactly. I was out most of the day yesterday. I couldn't follow it very closely, but I saw that the S&P and the NASDAQ finished down on the day, particularly the NASDAQ. Right now, the S&P is down 1.5 points. The NASDAQ is virtually unchanged. The NASDAQ futures at 73.57, NASDAQ 100 future. Currencies, I noticed even though precious metals got hammered yesterday, that the dollar got hammered against the yen. And normally when that happens, that's positive for the precious metals. But things never in markets, like in nature, I guess, you get really warm days sometimes in the winter and very cold days in the summer. So it's never perfect. Right now, though, the currencies, the pound is down about 0.12% at 130.75. Euros at 114.68, down 1/4%. And the dollar is stabilized against the yen. It's up about 10 pips, which is not much, 113.32. Oil prices rebounding a bit here. We saw a little bit of a correction down yesterday. Right now, WTI is at 74.64. So looks like we're right back up, from the 73 handle. It's up 2/3%. Brent crude 84.34, up 3/4%. Dollar yuan. Dollar has been strong against the yuan. We are now at 692. Been a while since we've seen this 90 handle, like 690. A few days ago, we were around 687, 688. So the dollar is strengthening against the yuan. Many of you think that they're pegging, the dollar yuan and also the price of gold. Maybe a little bit, but the same kind of thing happens to the European currencies. I don't think it's related particularly to the yuan. A lot of times when we see the pound go down, the price of gold and dollar goes down as well. I think all central bankers trying to manage their currencies, and of course the bigger central banks will be able to affect that management more easily. What about the bond markets? Just the the yields right now. I'll go into the broader subject in a minute. So yesterday it was a public holiday in the U.S., so the Treasury was closed. So the bond U.S. Treasury market was closed. But I can tell you right now that the 10-year yield is at you know at the high for the year. We're at 3.25, 3.25. So that has been the high so far overnight. The range has been 323 to 325. So we're up 2 basis points. So that means the price is lower. I can see here that T-notes or 10-year future is down about 0.2%. What about Italy? Italy yesterday, we saw a big spike. We broke through 350 and the 10-year yield or BTP yield. We went up to 363. Right now it's at 356. So it's still, Italy is still not out of the woods. So that's a big problem. I saw the Italian stock market made a new low for the year as well. Let's see where we are today. It's probably rebounded a little bit because the yields have come. Yeah, Italy now is up 50 points, but not really doing much. But yeah, it made a new low for the year. So yeah, as I said earlier, most the general public, when they think about markets, they think about the stock market. And it's understandable for them to think that the stock market is the most important market. But I would argue that it's not. It's not the biggest of the capital markets in the United States nor in the world. And as I said, I started in the late 80s working in finance, and the firm that hired me sent me even to London to do like an internship at their firm, and that firm in London sent me to what was called like a course, and it was conducted by Euro Market Trading Consultants, 1990, and I still have. It was a bond market workshop, February 1990, and I still got a little grid that they issued me. So here it is. You can see it here. And what's this grid? Well, it's annual to semi-annual, semi-annual to annual. So the bond market, I'm not trying to say people, the general public is stupid or anything, but the bond market usually they say it's for the smart investor, for the big investor, high net worth individuals. That's what people say, even though, of course, there are bond funds now that people can invest in, ETFs, but those are, you don't really buy a bond there, it's packaged. So what's annual to semi-annual? Well, that's how, I just wanted to point that out because that's how it can be complex. And back then, of course, 1990, you did have the Bloomberg terminal, but not many people did. Nowadays, you don't need one of these grids and like something like that to look at to work out annual to semi-annual and vice versa, because it's all done on computers. So what does that mean? And I'm trying to show this just to show you how it can be complex, the bond market. Well, the U.S. Treasury securities, they pay interest semi-annually, while European government bond securities like Bunds or BTPs, Germans or Italian, they pay interest annually. So when you quote U.S. Treasury yields, it's on a semi-annual basis. And what does that mean? Well, if you get paid the interest every 6 months and you reinvest it, your yield will be higher than a security that pays the yield only once a year. So a lot of times, I remember when I was dealing in corporate bonds, Euro bonds in the early 90s, if you're dealing for someone, you had to check, oh, is this a semi-annual or annual yield? Because it can make a big difference on the price of the bond, how to price a bond. And that's and that's how complex the bond markets are. There's a lot of maths, and I was told when I started out, and I bought this book many years ago, probably when I was doing this course, I was recommended to buy the Handbook of Fixed Income Securities by Frank Fabozzi and Dessa Fabozzi. And this is supposed to be the Bible for the bond market. So here it is. That's how big it is, you know. So what about, how big the bond market is? Well, I'll show you here from Zacks.com. They say bond market size versus stock market size. It says, while the stock market might get more press, the U.S. stock market total capitalization is a bit smaller than the bond market, though neither is small. The stock market has just over 30 trillion in total market cap, meaning the value of all outstanding shares, while the total amount of debt owed through bonds is more than 40 trillion. This is from May 2018, so it's quite, how can I say, recent, current. And then if you look at global financial assets, this chart here, this bar chart is pretty good. It only goes to 2014, but it gives you a general idea. I don't think the only thing that's changed is that it's gotten bigger and bigger, but you can see stock market capitalization 69 trillion, and then public debt securities, which is government and state debt, bonds, and then you get financial institution bonds. You add those up, that's 118 already. Non-financial corporate bonds, so that's like 150 trillion. That's a lot bigger than the stock market worldwide. And then you have like securitized loans, non-securitized loans, which are not really in the bond market, but you can see how important the bond market is in comparison to the stock market worldwide. And the other thing about the bond market, there are no bond market exchanges. Yes, some bonds might trade on some stock exchanges, but it's not like you can call the New York Bond Exchange and get a price. The bond market is a market where it's an over-the-counter market. Everyone knows each other fairly well, even worldwide, between Europe and the US. It's made up of the banks make markets on bonds. You have the broker dealers. You have investment banks who make markets on bonds. You have small, financial institutions who make markets on bonds. You have the IDBs, interdealer brokers, who only match bond sellers and buyers. They don't make markets. But what I'm trying to say is that, yes, it's the biggest, most liquid, you could argue most liquid market in the world compared to the stock market. But if things get hairy out there, volatility increases, these dealers will not pick up the phone. And if they do, they'll make you a price as wide as the QE2 or the Queen Mary or the Titanic, so to speak. And but in the stock market, there are exchanges and prices are more, how can I say, transparent. So if things get volatile, the bond market could be, the Achilles heel of the financial system. And why? Well, because that's how corporations finance themselves, through the bond market, governments, financial institutions. Why do you think, how do you think the big multinational corporations, the blue chips corporations in the last few years have been able to do the stock buybacks? Well, they've issued bonds to raise cash and take that cash and buy their stocks back, buy their shares back. So that's how important it is. And the other point I'd like to make, not just for the bond markets, but all the financial markets in general, is that since the crisis of '08, they really haven't fixed anything. But one thing that the regulators have insisted upon for all financial institutions is a lot more compliance. So I would say even though the debt has gotten higher, there's more financial assets out there. The number of real bread and butter dealers, traders is decreased. The number of compliance officers, the number of also computer programmers is mushroomed. And a lot of broker dealers have gone out of business because the small ones can't afford all the regulatory burden. And I think that makes the market even more susceptible to crisis. And this was done in trying to avert crisis. So you can see how governments and bureaucrats, the things they do always has the negative effect or inverse effect that they envisioned. And you can bet if there is a next crisis, and I think there will be, one of the things they're going to talk about is that there was too much compliance. There's not enough, soldiers on the front line. There's too many, generals and other officers, but not enough people fighting on the front line. That's the best analogy. So I've got here from SIFMA.org, and number of dealers declines. And it says the number of registered U.S. broker-dealers is down 31% from the 1997 peak to 3,835, after averaging 5,449 in the 1990s. So you see, in the 1990s, when capital markets were even smaller, the number of primary dealers was even bigger. The number of primary dealers, vital market participants in maintaining efficient U.S. Treasury markets, have also declined, while averaging 38 in the 1990s. This number settled in the low 20s after rebounding from only 17 in 2008. While some of the pre-crisis decline in the number of broker-dealers can be attributed to normal industry consolidation to gain scale, the current number of firms is down 23% since 2007. We infer the recent decrease in numbers is at least partially attributable to an increase in compliance costs from the hundreds of new post-crisis regulations to which financial institutions are subject. So you can see there that they've tried to make sure the crisis doesn't happen again, but they've actually maybe created, a situation where a crisis will be inevitable. So bond markets, very important, even though it doesn't get, the main press headlines. The other thing I'll talk about probably in the next video or two is the derivatives market, which is basically side bets on all these capital markets, bond markets, stock markets, commodity markets. And it's a huge casino, and it's what could trigger the crisis, because the side bets are many times over the underlying size of the assets that people are betting upon. So if you enjoyed this video, please like, share it far and wide. Subscribe to my channel if you haven't yet. You can also follow me on Steemit, DTube, and on Twitter. Have a great day. I'll talk to you later. Take care. Bye.